Hello and welcome to the Albertsons LBO presentation.
In 1939, Joe Albertson opened his first grocery store in Boise, Idaho. The company quickly grew, and in 1969 they went public on the New York Stock Exchange. Also in that year, they formed a partnership with Skaggs Company to operate food and drug units. In 1999, American Stores Company joined forces with Albertsons, and because of this, they became one of the largest supermarket chains in the country. In the late 1980s, there was an emerging trend in mergers and leveraged buyouts. Starting in 1990, one-stop shopping increased once again in popularity. Albertsons took advantages of these rising trends and combined with Safeway. After this combination, Albertsons became one of the dominant players in the industry, along with Safeway, Kroger, and Walmart. Albertsons reached a point in which they were seeking strategic alternatives, and on January 23, 2006, they reached an agreement with the winning bidder of consortium investors, which included Safeway, CVS, and Cerberus Capital, to sell the company for $17.4 billion. Albertsons shareholders grew to a premium of about 27% from the time in which they were seeking strategic alternatives, and their shares were now worth $26.29. Notable competitors who placed bids include Kroger, but it might have been good that this deal had gone through because analysts called the deal distracting and problematic. Another consortium consisted of KKR, Texas Pacific Group, and Apollo Management, who were also bidding but did not get it. The date of the acquisition was the 2nd of June of 2006. After the acquisition, Albertsons became a fully owned subsidiary of SuperValu. As you can see in the chart below in the successors section, which highlights the financial material immediately after the transaction, the net earnings as a percentage of sales grew to 1.39%, showing that immediately after the company became more profitable. As stated previously, the three members of the acquisition include SuperValu, CVS Pharmacy, and Cerberus Capital Management, who led a consortium of a few different investors. SuperValu is a grocery industry leader and were interested in this deal because of previous success that they have had in acquisitions. They also wanted to implement their strategy of operating a diversified portfolio of regional banners. In this deal, they received 1,124 operating stores, and as a result, SuperValu became the second largest supermarket company in America, behind Kroger Company. CVS Pharmacy, a retail pharmacy and innovation company, became interested in this deal to create key cost synergies through economies of scale and to benefit from high-volume stores in fast-growing markets. They also intended to sell some valuable real estate soon after the transaction. CVS acquired 700 freestanding stores, which is all of the standalone drugstore business that included their banner on it. As a result, CVS became the nation's largest retail pharmacy chain. Cerberus Capital is a large fund that specializes in areas including private equity and real estate. Cerberus led a consortium of other investors including Kimco Realty, Schottenstein Realty, Luber Adler Partners, and Clough Realty. Cerberus, along with these other investors, were interested in operating the profitable companies and selling the remaining properties to unlock the real estate value associated. These investors received 655 operating stores, along with all the distribution centers in the Dallas, Florida, Northern California, Rocky Mountain, and Southwestern regions. They also purchased 26 Cub stores from SuperValu for an undisclosed amount.
The events leading up to the Albertsons transaction started with the grocer's acquisition of American Stores Company for $11.7 billion in 1998. Forming one of the largest retail food chains with over 2,400 stores. By April 2001, the company struggled to compete with wholesale merchandisers and the Walmart effect on the industry. Albertsons hired Larry Johnston as CEO to restructure the company, including closing low-performing stores and reducing waste in the supply chain. By September of 2005, Albertsons hired Goldman Sachs and Blackstone to seek out strategic alternatives, which included a potential sale. By January of 2006, the company closed the $17.4 billion deal to be acquired by SuperValu's CVS, Cerberus, and Kimco Realty Corp.
The offer price was for $26.29 per share. This was the $20.35 price per Albertsons share and an 18% value of SuperValu shares. This was a total transaction value of $17.4 billion and $6.2 billion in debt. This share price represents a 27% premium to the announcement of seeking strategic alternatives. 28% premium from the end of 2005 when talks initially broke down, a 16% premium from a week prior to the deal announcement, and then only 9% premium 2 days prior to the announcement. Compared to many LBO deals, the syndicate had a leverage multiple of 2.4x debt to EBITDA.
For the sources and uses of the transaction, the loans taken out included a term loan, a credit revolver, a term loan A, and a term loan B. The loans were priced at LIBOR plus 1.5% on pro rata loans and LIBOR plus 1.75% on institutional term loans. The fundraising of debt was led by the Royal Bank of Scotland and included a syndicate of fundraisers such as Bank of America, Citibank, and Royal Bank. For the uses of the funds, it is assumed that the company was restructured, thus paying off the debt that Albertsons had before the deal, equating to $5.7 billion. As part of the deal, SuperValue purchased Albertsons with a portion of equity equating to an equity rollover of 35% of SuperValue's equity portion in the deal. This contributed to a post-deal ownership of 19.8% for existing Albertsons shareholders. The rest of the ownership comprised of SuperValue, CVS, and the financial sponsors of the deal led by Cerberus. The capital structure post-deal consisted of a 36% debt portion of ownership and a 64% equity ownership of Albertsons.
From a regulatory perspective, the deal was subject to approval by Albertsons shareholders, SuperValue shareholders, the expiration of the Hart-Scott-Rodino Antitrust Act, and approval from the New York Stock Exchange for additional SuperValue shares. The deal was subject to termination fees ranging from $70 to $276 million, depending on who in the deal decided to withdraw. The new entity post-deal would be responsible for all taxes of both corporations prior to the merger. From an accounting perspective, the deal was used under purchase method accounting, which helped benefit SuperValue's financial statements. The deal increased the size of retail food segment by 21%.
The Albertsons transaction placed a large amount of debt on SuperValue's balance sheet, leading to struggles to keep a consistent cash flow. As shown in the graphic below, SuperValue saw their operating cash flows decline 48% from 2008 to 2013. With the recession and losing customers to rivals such as Walmart and Kroger, the struggle to compete and lack of cash flow led to a poor performance on SuperValue's stock price, as shown in the graphic below, where SuperValue's stock price is compared to that of the S&P 500 during this time. These events led to SuperValue's sale of Albertsons and other grocery stores to a Cerberus-led group for $3.3 billion in January of 2013. The transaction involved only $100 million in cash and involved SuperValue unloading $3 billion of debt off their balance sheet. On the day of the announcement, the market reacted to SuperValue and their shares rose 7.9%. Leading a group that included Kimco Realty and Claff Realty, Cerberus acquired 877 grocery stores from SuperValue, including bringing all Albertsons stores under one roof. The consortium on the deal also created a subsidiary, Symphony Investors, to acquire up to 30% of SuperValue's shares. This resulted in Symphony gaining 21% ownership of SuperValue with 54 million shares. In March of 2014, Cerberus led a consortium in an acquisition of the Safeway supermarket chain for $9.2 billion, including $7.6 billion in debt. The idea Cerberus had behind this transaction was to merge Safeway and Albertsons, and by January of 2015, the two grocers were able to complete the merger to include a network of 2,200 stores nationwide. With the inclusion of the Safeway merger, in 2015, Albertsons would recognize a trailing 12-month profit of $800 million with $57 billion in revenue. This success led to the rumors of IPO for the large supermarket chain. But due to difficult market conditions for brick-and-mortar retailers and declining sales growth, Albertsons held off their IPO. In April of 2017, Albertsons sought to acquire the high-end grocer Whole Foods and was seeking to IPO by the end of the year upon completion of the transaction. However, Amazon came in and beat out Albertsons to acquire Whole Foods. Due to conflicting factors such as missing out on this acquisition, Amazon's ability to cut costs in the industry, and Blue Apron's struggle in their IPO, plans for Albertsons to go public became unlikely in 2017.